Good evening, ladies and gentlemen. Welcome back to Walk the Block. We are navigating digital finance all together. I'm your host Zenith, and I am joined by my excellent co-host Tracker. How you doing, buddy?
Doing well, man. Doing well. Looks like markets are trying to find a bottom right here, trying to find some footing here. I think we could be, um, just like everybody else, waiting to see what's going on here. Um, I'm looking forward to getting into this because there's some good information we're going to be sharing tonight.
Absolutely. And for the folks at home, we are now officially 1 week past when quantitative tightening ended. So we're going to take a look at what has been going on. Spoiler alert, it's not a whole lot because it's not a lot of time, but we are going to break down some historical trends about what has happened previously and how big were the moves when the Fed has done quantitative easing and tightening, just to give some perspective about what we could potentially expect to see. Outside of that, there's also a bit of a subtopic that's been going on that we we kind of put together at the last minute there, which is that privacy tokens are a little bit all the rave right now. We got a lot of people talking about it, whether it's the SEC, who's actually hosting a roundtable forum on it coming up next Monday, or we actually also have a pulse chain project called Railgun that was recently launched, and Liberty Finance, our guys over there, they like talking about that, and also the original ZK swap protocol on Ethereum is actually getting sunset somewhat soon. So weird how all those things just lined up together. But outside of that, we got all that and more. So with that being said, I guess final point is also little thing called the Binance conference might have happened, and everyone's favorite Ethereum holder Tom Lee made a big presentation going on over there talking about what he thinks is going to be going on with Ethereum. And we also have been tracking what his company has been doing with their wallets. Spoiler alert, they are 60% of the way to their 5% supply of Ethereum goal. And yes, they did put in another pretty big order today. So we're going to be diving into all of that. Alrighty, first up, quantitative easing and tightening. My friend, it is here. Have you seen anything in the markets move as a result of this?
Quantitative tightening?
Yeah, it's over now. So did we gigapump to the moon? What's been going
No,
on?
no, 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 no.
Oh,
Take some time, man. Take some time.
that's true. So for the guys that caught the episode, gosh, it was probably a month ago we talked about it, but we were asking the question, how long does it take for this stuff to really take effect? Well, the answer is for markets, it can be pretty immediate. In fact, it can actually be preemptive. Based on some of the research we've been doing behind the scenes over here, we've seen that previously it's honestly gone on even like a month or two before the actual changes were made. The markets were kind of just anticipating the change to happen. And then other times, namely like COVID, where it was very instantaneous, that didn't have as much time to react. So it was pretty close to the announcement when it came out, maybe a little bit before, but we're talking like a day or hours even at that point. Outside of that, that's the markets. What about the underlying economic data? Well, research has showed it takes anywhere between 3 to 6 months. So, looking at the timeline, we started cutting rates in September. We are coming up on another Federal Reserve meeting here on Wednesday, actually. So, we're going to be probably talking about the results of that on next Monday's show. But as it stands right now, the big change that's happened is that quantitative tightening did end on Monday. So, what does that mean? Well, it means that the Federal Reserve is no longer selling off their balance sheet, aka trying to pull money out of the market and give them bonds back. Instead, what we're looking at is now we're in a period where there's no quantitative easing, but there's no quantitative tightening. What that looks like is that the Fed is kind of going into maintaining reserves mode. What that means in practicality is baby quantitative easing, which is that the market needs liquidity to operate so that the banks can do all their end of day settlements with each other and make sure the books are proper. What that does is it means that there will be a small injection of liquidity into the market over time that will start to add up. However, it's nothing like full on money printing. But at the same time, though, we do have that Fed meeting coming up. So the question is, when do we see quantitative easing? I think we've talked about it a little bit in the past. Our bets are probably a little bit of ways off, but as it stands right now, it's possible. I'm not saying it's likely, but it's possible. Tracker, what do you think the timeline's looking like for quantitative easing to come back?
No, we've talked about this. I don't. I mean, well, they are already buying treasuries, so I don't know if that's. And now it's not quantitative easing, but they are already starting to do that. Quantitative tightening's dead, so that's the first step. Next step is obviously the rate cuts, which they're doing, and then if they have to get more aggressive, then you'll see quantitative easing coming in. But like I said, they're already helping the economy by coming in and buying it. And also, we saw what happened in the silver market. where we talked about it briefly last week, how the banks that were shorting silver, it's funny how those servers went down when silver price started going up, causing a short squeeze. All of a sudden the servers go down, and then there was this massive amount of money that was injected to the banks to cover shorts. Now, I advise people to look into that because once again, there's too many pieces going on there. So there's isolated events that you're already seeing the government injecting liquidity or doing more or less quantitative easing or giving out money to various areas. You're also going to see that with the stable coins obviously occurring and buying up treasuries to buy US debt. So it's not technically quantitative easing, but it certainly is. All these steps are pointing to government is stepping in to backstop the entire economy and inject it and get it really moving. So, and then of course, what we talked about over the last few weeks, once again, you're trying to fight the battle with trying to Wall Street trying to boost the economy at the same time while Main Street is feeling this really tough pain right now that's going on. So that's what everyone's on the fence about. And this market is also very long in the tooth. It's been running for a while. So a lot of people are trying to step out of this boat. It's weird. We've had this long run, but now all of a sudden we're going to start having quantitative, easing and rate cuts and all this stuff potentially coming. Of course, the new Fed's going to be more aggressive, most likely. So all these things are lining up for that. But like we were talking about in the green room, quantitative tightening or when rate cuts start to happen, it typically takes anywhere between 3 or we'll say even 4 to 6 months before you see that money really trickling in there. And of course, everybody who's holding altcoins or Ethereum, anything non-Bitcoin, we're all waiting for the ISBN number that we always talk about. Well, that's not going to start moving until you start getting more liquidity and more, urge for people to actually purchase and, turn on purchasing power and actually spend. But the other counter side of that, the more bear side of that is there's been people taking the other stance saying, well, even if I do inject all this money, it's not going to do me any good because the economy's not good. What am I going to lend money to people that may just default on it? Or is it high risk? I mean, you got to understand, like, what's the underlying, for how bad is the economy? And right now with data being manipulated and information not even being released out there because of the government shutdowns or them just not deciding to even release the data, it's definitely just throwing in another uncertainty. So, but one thing is certain, this economy is going to be very aggressive with whatever it has to do to try to get this economy really moving. So that's one thing I would not want to bet against.
That makes complete sense. I think probably, I don't even want to call it a point of disagreement, but I think that a lot of what you've mentioned for when quantitative easing is going to start is that you make the argument that when they get a new Fed chair in there, there's a decent argument that it's going to be someone who wants to do that. I think that it could possibly even come a little bit sooner than that. I think Jerome Powell does have the ability to, or it's within his wheelhouse to do this kind of thing before he leaves. Because I think he's going to want to try to keep it going, just keep the sterling reputation, just keep doing the job, doing the work, that kind of stuff. But the underlying question about why we even talk about all this, actually, we got a good little screen share here from our buddy Dace, which is that this is the Bitcoin market pretty much back through 2017. And what this chart is showing is we have periods of quantitative tightening, periods of quantitative easing, periods of quantitative tightening. But there are also those small little gaps in the middle. We are entering one of those new gaps right now where quantitative tightening is over. So that red zone on the right side of the screen, that's going to stop. But the chart will keep going. What you see at that line at the bottom, that is overnight repurchase agreements. That is what I mentioned earlier on. That is pretty much where you see the Federal Reserve helping the banks adjust the balance sheets at their close of business, pretty much to make sure that all the money all the money is accounted for. So during this time, we kind of have a tendency to see the overnight repurchasing agreements start going up. We've already seen news announcements of these kinds of things. I believe we saw last week there was an announcement about like $35 billion, which is that a lot of money? Yes. Is it a lot of money in comparison to when you put these entire zones of tightening and easing in aggregate? The answer to that one is no. But little point of interest, if you look down at the line on the very right side, it did tick up. And that is exactly what we're looking at here. So based on previous trends, it makes sense to believe that we're going to see more of these overnight repurchase agreements. And, well, as the chart shows, it looks like it's actually decently correlated to asset prices, in this case, Bitcoin, going up. Granted, the big grain of salt to take with this one is that this is a very different market than the previous one that we had, namely because traditional finance is in the game and the amount of money that has come in through that avenue is massive. So Will we have the same outsized returns? Possibly. There are people out there, cough, cough, Tom Lee, that believe that we will see those kinds of gains. But at the same time, based on everything that's been going on this cycle, I imagine we will see some gains, but I don't think it's going to be anything crazy. And the other grain of salt to take with this one is that this is still based on the new theory that 4-year cycle is dead, and that because if you go off the previous indicators, we did have our top in October 6th, I want to say, at $126,000 Bitcoin. That was a very low target back 2-3 years ago when people were speculating based on Fibonacci polls and level extensions and that kind of stuff about where the top of the market could be. So what this chart really shows is that this is data in favor of the idea that we are going to be continuing the bull market into Q1, Q2 of 2026. I happen to personally think Q2 might be a little long in the tooth, but at the same time, a period of quantitative easing could be coming. And again, we'll get into it a little bit later, but there are alternative theories out there that this bull run could be far away from over as well. So, yeah. I don't know. Any thoughts on the overnight repurchasing agreements? I know that was a bit of a soapbox there. I apologize.
No, just that I just think you're going to see more of it. You're going to see more adjustments going on. You're already seeing this happen across the different economies as well. Like the U.S. is going to come step in and start purchasing. I know we talked about this about 4 or 5 weeks ago, that it's really around more or less like the issue that they're having is really the underlying problem is the debt. U.S. has a lot of debt. They're going to solve it by using, stable coins. It seems to be the solution that they're going to start leaning towards. Other countries like the BRICS are leaning towards the more that gold vaulting strategy that they're talking about doing, where it's going to be separate. But bottom line is everyone's trying to solve the same problem, and that is stem inflation. They want inflation to stop or control the debt. Either or. The BRICS want to get away from the inflation. U.S. can control the inflation and keep it under control, but they're always going to keep printing and they're going to keep manipulating. It's just they're drunk on power when it comes to the ability to print more, because in the short term it solves their problems. Long term, it's highly destructive. So there's nothing keeping them from doing it, unfortunately.
That is fair. Tell you what, I guess the final point on this one is like, I think we're still a little bit of ways from full on quantitative easing. At the same time, though, I would expect that there's going to be a good amount of churn or fluctuation or just volatility between now and when we get the official announcement for quantitative easing effectively. Like we talked about, the markets are going to speculate about when it's possible, and there's a decent chance they can move in advance. But at the same time, we're looking at the underlying economic factors. Again, it's going to take months. So overall economy, months out. Markets a little more speculative, so they're going to move a little more immediately or even preemptively. But to close it out, yes, I mentioned it before, we do have Federal Reserve meeting coming up on Wednesday. As it stands right now, yeah, we're looking at a 1/4 point cut coming down. This is our FedWatch tool by the CME Group. This is based on the futures markets. They have it at an 87.3% chance of a 1/4 point cut. And the only other option is no cut at 12%. We're getting closer to the date, so the numbers are definitely converging on what is probably the two most probable scenarios, which is no cut, 1/4 point cut. And if we want to flip over to everyone's favorite betting website, Polymarket, you can see that the betting markets over there do currently have 94% chance of 1/4 point decrease, and it's actually a pretty good volume market. Although what's crazy is that there's $38 million in volume for the 1/4 point cut, but $111 million for a 1/2 point cut. That one seems a bit odd to me, but I don't know if there's too much to read into that on that one. It's just people throwing around money because they like gambling.
All I know is if they do a 50 bips, the market's going to rip. It's going to absolutely rip if they did that. I don't see them happening. I did not with this administration under Trump Powell. There's no way. I don't see that happening. There will be a 1/2 cut. They will do 25 bips, no question about it. Then the question is, what about the next meeting? I'm kind of forward thinking. I know it's way out. I was just curious, what's the percentage on the next time that they meet? Will they cut again?
Let's take a
I was
peek.
more curious about that.
Looking over at FedWatch. So the column on the right, that is the no cut. Column in the middle, that is the 1/4 point cut. And the column on the left, that is half point cut from where we are currently. So keep in mind, 2 meetings from now, not the next one, but including the next one as well. It's in aggregate. So
Gotcha.
this sort of prediction relies upon what they do on this one as well. But as it stands, 66% chance for singular quarter point cut, 24% chance for consecutive quarter point cuts. So we've had 2 cuts. We're anticipating a third.
Yeah.
This one's saying, are we going to get 4? And as it stands right now, the odds are in favor of a single. But if you want to, I guess, speculate a little bit, it's saying that there's a greater likelihood that we're going to get 2 consecutive cuts than we're going to get 2 consecutive no cuts. But again, it compounds on itself. And also, we're like 47 days out from the next one. So it's going to be a while for that. And as we've seen with this kind of data before, it's subject to change, especially when you're that far out.
Yeah, the quarter percent coming up this week. That's a no-brainer. It's going to happen. And then we're just going to have to wait and see what happens towards going into January. That everyone's going to be. And that's also things you got to keep an eye on for the markets. Most people aren't going to be doing a whole lot in December, at least with the TradFi. They've already had a good year. Most people are just going to kind of keep things moving along. And then in January, when they start coming out with their game plans for going into the next year, that's when they're going to start laying out. That's when you'll start seeing potentially portfolios being readjusted and things of that nature on what they're working on. So a lot of them working on basically what's that going to look like when they get into January. So we'll have to sit back and watch.
That we will. But until then, we do have a good bit of entertainment, or at least entertaining things that have happened lately. Thank you, good sir, for pulling some clips from this. Folks, this is the Binance conference, and the man you see on the screen in front of you, his name is Tom Lee. And, well, he is the leader of BitMine. What's the rest of their company name? BitMine Immersion Technology. So he gave a keynote presentation at the Binance conference. We've got a few little treats for you. We're going to play them, break them down, and then just keep rolling through them. Because
hey, Zena, but before we get into that, I do want to give everybody who's not familiar with Tom Lee. Tom Lee's been around for a long time. He's also the one that told people to start. They started investing in Bitcoin in 2017. He was telling everybody that it was going to be. It's kind of like digital gold is how he was looking at, how he was perceiving it back then. You can go back and look at clips from him pushing it back then. He's been very bullish. He's always invested in like disruptive technologies, kind of similar to how ARK investment with Kathy Woods is. They focus on a lot of that kind of stuff, disruptive technologies, which obviously crypto is in that realm. And he's been pretty spot on throughout the years with his bets. And so basically he has got a lot of clout in the TradFi world. When he speaks, what people they're going to start listening. What I liked about this presentation, we're going to have a couple clips here, but what I'd recommend is anybody who hasn't seen this, don't just listen to the clips people keep putting out, memes they keep putting out. Go back and actually watch it and form your own opinion from yourself. It was a very clean and a very concise and easy to understand presentation he laid out. Anybody could pretty much understand most of it. And there might be some acronyms and things like that people don't know, but all in all, it's pretty straightforward and very clear to understand and why he is in the position that he's in and what he's looking at. And what's nice about it is he's trying to apply TradFi, understanding how to analyze analytics and everything with TradFi and applying it to the crypto markets and why the investments are there. And by doing so, he's able to also probably expose things that not really are talked about a lot. Now, we talk on the show quite a few of the things that he hits on in this presentation, but he does a really good job of laying out even more. And we'll go into the couple of the clips. And I think the first one you have is why crypto prices, like why he thinks it's bottomed out, correct?
Yes, sir.
Yep.
All right, let's hear from the man.
Okay. So let me explain to you why I think crypto prices have bottomed. First of all, crypto is acting like there's a crypto winter because gold's up 61% year to date. S&P's up almost 20%, and you can see Bitcoin and Ethereum actually are negative year to date. And I really like this article by Jeff Dorman at Arca, who said, the selling that nobody can explain. I think many people can say why they think crypto prices have fallen, but nobody really understands why. But here's what I just want to point out. This is Bitcoin's year-to-date performance. And Bitcoin was having a good year until October 10th. Now, after October 10th, a lot of people tried to explain why crypto is declining. It's the quantum risk to Bitcoin. Crypto winter starting. I have so many traditional investors telling me that's the only reason. They say, Tom, it's the 4-year cycle. Of course, we had the October 10th liquidation event, the biggest liquidation in history. A lot of people say it's the AI stocks have captured mind share. MicroStrategy recently said they might sell their Bitcoin. That scared some people. MSCI may exclude digital asset treasuries from indexes. And of course, Tether got a ratings downgrade. So maybe some of these could explain why crypto's down. But just keep in mind, crypto was up 36% until October 10th, and then it's gone straight down. I personally think it has a lot to do with deleveraging. And as you know, after the FTX collapse, it did take 8 weeks before market makers recovered and crypto could start to see price discovery again. And we're basically 7.5 weeks past that event. Now, Bitcoin made a decision.
Alrighty. So that's the argument for why the prices have bottomed. Makes an interesting point there, especially the time frame one. That is actually probably one of the new pieces of information that I think people have not really connected. So what he referred to there was the FTX collapse. That was this bear market effectively. And by that, I mean the one that happened like 3 years ago at this point. The FTX collapse was the mark of the Bitcoin low at $15,700. And he's saying it took 8 weeks to recover. Well, if we look at where we're at, yeah, we're right about that time frame. And he's saying that based on historical events, he would be expecting something like that to take 8 weeks. All right, that's a full 60 days. What does it look like on the weekly chart? 9 weeks to the current week that just started, by the way. So if you go from the 6th of October on the weekly chart, that's where it starts, to today, that's a full 8 weeks. And well, if we look at the chart, it's not a terrible bottom. I mean, from a structure standpoint, if you want to look at it on the daily, we're seeing higher lows being built and we're on price, and we're also seeing higher lows being built on RSI. So it looks decent. I mean, if anything, we have actually gotten higher than some of the previous areas that we had on the way down here. But granted, we're nowhere near when we were literally in the overbought area for the all-time highs. But overall, like, we're approaching that 50 mark, currently sitting at 44. So it seems plausible.
The thing that I find interesting was, like, he was also sitting there saying, like, hey, there's a lot of narratives that we can explain why the crypto market's going down. And I think we actually had a show, 2 weeks ago, 3 weeks ago, where we were trying to go through all the different narratives of why the crypto markets are getting beat up. And it was like, pick your poison, which one? They're all valid. I mean, they're all pretty, they all have a lot of clout behind them. So yeah, I think it's pretty interesting. The deleveraging play makes a lot of sense, and it's being blown out of there. So that makes it definitely feels like, now, is this the bottom? I mean, he thinks it is the bottom. Now, I don't know if it's the bottom. I don't know. Meaning, like, this is just going to be a temporary bounce. We're going to go back up. But it's interesting. A lot of people are sitting on the sidelines waiting for that Fibonacci retracement bounce to get up to certain levels, right? That roughly a 50% retracement from the lows we just hit to the top, to the all-time highs, and that's where most people are going to be doing a selling zone. So once again, we keep talking about max pain. Well, this would just drive people crazy. We hit a bottom. Now we're kind of just chopping, slowly grinding up, and you're not getting this quick snapback bounce, which is more sustainable. So I mean, yeah, only time will tell, of course. You want to dive into the next one?
Yeah, but real quick, I mean, look, is Tom Lee the big man of the hour giving the famous speech at the Binance conference? Yes. Were we maybe kind of coming to similar conclusions a little bit before he gave the talk about why the market's actually crashed, what's going on? I would also say yes. So shout out to you, shout out to Dace, maybe a little pat on the back from me as well. But, like,
sure.
Again, he covers a really important point, which is that previously we've pretty much run dead set on the 4-year cycle. Granted, there was talk last cycle about an extended cycle, the super cycle, whatever. Did people get wrecked from it? Yeah, they did. So why are we not the crazy people shouting the same thing this time? Well, I think he laid it out decently well there, which is that October 10th, the greatest liquidation event in crypto history, $19 billion wiped off this slate just like that. then we had continued downside pressure, whether it was from mainstream media or legacy media, excuse me. There's those dinosaurs over there trying to flood the markets. We had the great MicroStrategies kerfuffle where they're like, if it goes low enough, they'll have to sell, and then they didn't make a great press statement about clarifying that. Ultimately, we did get some clarification, but at the end of the day, a lot of fears about the biggest guy out there, Michael Saylor, selling. A lot of fears in the markets. Fear and greed index all the way down to 10. By the way, it's still sitting around like 20-ish. It really has not recovered very much at all, even though, well, the market looks like I showed on the charts. We're slowly building back up, but sentiment is still very much down. So all those things are what's pointing against four-year narrative. And it also factors in all the stuff we talked about previously about quantitative easing coming down the pipeline. So that's the kind of stuff. So look, I like the argument. I'm still a coin toss on whether or not it's over or not. And that's largely because, like, 4-year cycle, I think historical trends are strong. And we got to assume the trend is going to hold until it's proven to be broken. I don't think we've proven that case yet. We're still down. We're not back up. So again, we got some of the biggest fish in the game, the whales out there, some of the brightest people in the crypto space, the TradFi space. They're all trying to wrap their head around, is this actually happening? Or are we just the crazy people shout super cycle again?
Well, the next clip, he's going to go into explaining why crypto has fallen on this 4-year cycle. I know we understand the halvings involved and whatnot. He talks about that, but he does a really good job talking about that, the copper gold market and the ISM indicator, which we've been all over that thing. So this is a really good clip of what he feels is the justification on why crypto has just fallen into this 4-year cycle and why he thinks it's broken going forward, at least for this time around.
Fair enough. Let's see what the band has to say.
Ethereum. But let's go back to the 4-year price cycle for Bitcoin, because it's still hard to escape this chart.
Little point of order. Notice how the time periods are 3.91 years. Someone might almost call that 3 years and 11 months. I'm just saying. I've mentioned it once or twice before.
We have 3 times since the history of Bitcoin, the 4-year cycle, or 3.91 years, exactly called the top and the lows. So the question is, why is Bitcoin subject to a 4-year cycle? We asked the Fundstrat Digital Assets team to give us the 5 most logical reasons for this. There's the halvening cycle, there's monetary policy, margin debt. But the 2 things that I think have actually become more important in our view is gold versus copper, and then the ISM, which is just your traditional economic business cycle. So let me explain. So the halving could explain Bitcoin because the halving is pre-computed, but the problem with the halving cycle explaining Bitcoin's price is that there's a lot of other things that have a 4-year cycle: presidential elections, Olympics, World Cup, etc. But there are some things that follow a 4-year price cycle that no longer follow a 4-year price cycle. And one of them is copper versus gold. And this is a tweet from AO BTC analyst. And we decided to recreate it, which is, let's look at the ratio of copper prices, which is measuring industrial activity, to monetary base, which is gold. And in the past, you can see it had a predictable 4-year cycle, except this time. And if you line it up with Bitcoin and copper, they actually line up almost perfectly. But copper and gold are not in a 4-year cycle now, because that ratio should have peaked this year. Similarly, is ISM. ISM is a measure of US economic activity, and historically that had a 4-year cycle. But as you can see, the ISM is not following a 4-year cycle today. It's actually stayed below 50 for almost 3.5 years. If you line up the ISM to Bitcoin, you can see it almost perfectly explained every Bitcoin cycle, including the original Bitcoin price peak. So it's even more explanatory than the 4-year cycle. But again, this time the ISM is not peaking. So here's the question I'd ask you. If the industrial cycle is no longer following a 4-year cycle, and copper gold isn't following a 4-year cycle, I'm going to say I don't know if Bitcoin should follow a 4-year cycle. So I'm not in the camp that Bitcoin price has peaked. And the only way we'll know is if we make new highs in January, which is our bet.
All right, there you go. Tom Lee, the man himself, said that the World Cup dictates the markets.
I think what he was trying to say,
It was
yeah,
good.
yeah,
It was good.
yeah,
It was a really good one.
yeah. But if you notice that chart, he's just saying like there's a lot of things that have a 4-year cycle and the French, so you have 4-year with the presidential life cycle. Okay, well, new administration, new policies come in. We've obviously had to live that here through the United States. That's been going on. The ISM number, 100%. Gold to crypto is an interesting combination because really the ISM number and crypto and copper are going to go right hand in hand because copper is used so heavily in industrial development. Gold is not. Silver is. So you could also throw silver into that mix too. But silver is kind of like, it's weird. Silver is, some people treat it as if it's like gold. Some people treat it like it's a copper or an industrial thing. Silver is used in a lot of infrastructure development and various developments. So if you lay all that in there and you see what he's saying, it's like, hey, this is going to exactly explain why we haven't gone. We've been all over the ISM number. Heck, we've been saying it almost every week that we're not going up until the ISM number crosses over, 52. And it's been stuck around the upper 40s right now. And it just is the longest period we've gone sideways in ISM number, which if you tack that into the place, you tack into risk on assets and so forth, you can see why crypto is not there. Now, you do have people believing still heavily that the 4-year cycle is the 4-year. It's gospel. It is what it is. And they're going to take action and do what they do. And that's probably another narrative of why the crypto markets have gone down. So it's just, and of course, that leads into people who have been holding for long periods of time that are just starting to load some of their positions. But like we did point out, and we've shown a lot of data around this, institutions are accumulating. The retailer are the ones that are dumping. Now, there is manipulation. Don't get me wrong. The central exchanges and some of the big institutions had dropped the market, just like that little blip that we had when we hit the recent lows, just the last few weeks. You saw the big players selling. Well, those are the same players that were coming back and buying. And a lot of it's the central exchanges because they have a lot of buying power. But the big institutions, they just keep accumulating. They're not selling. They're just accumulating hand over fist because they're looking at, like we've talked about many times, they're looking at decades. They're not even looking at years, in my opinion. So
that makes sense.
They just started the accumulation process. So if you lay over that layout, I mean, it's an interesting case. Like I said, they're betting. Thought it was interesting at the very end, if you caught what he said, that they feel like, that we should start, moving up heavily and then by January. So we'll see.
That's true. That was a really good slide right there, by the way, actually. Just the idea of tracking the markets like copper versus gold. They're great analogies for the bigger things going on with each of them. Obviously, gold tied to monetary system. Copper is more tied to industry, and what I would argue is actually like GDP growth. So the reason the chart is important for what they're trying to show and why it ties into the ISM so nicely is that they're measuring similar things, but it's just something easy to get a price figure for and also kind of wrap your head around. So if money is expanding, it doesn't necessarily mean that your GDP or your economy is also expanding. A lot of times when we see the business cycle really get to that a good bull run for the business cycle, we see expansion of GDP, expansion of economy. That ultimately does start to cause some inflation just naturally based on how the business cycle works, but it's a great analogy for it. The thing that we haven't seen this time around is that are the GDP numbers as reported by the Bureau of Labor Statistics still looking pretty good? Yes, they've been on track, slightly behind, but still ahead of inflation. So that's a good thing. At the same time, though, that doesn't tell the whole story. And I think it goes into all the other stuff we've been talking about, which is like overall jobs, international economy, different like the Ukraine conflict going on, that kind of stuff that really just kind of screws up the business cycle. But I think that I really like that one. I think it's great. I'm probably going to start tracking it myself. But at the same time, though, again, this dives back into the question, okay, why are we off the 4-year cycle? 4-year cycle has been gospel pretty much, but like you talked about there's a lot of things that are in the 4-year cycle. This time is different because we're actually seeing that the 4-year cycle is the one that is now no longer in coordination with the other ones. So that's why I think it's such a compelling argument. And I know we keep going back to the question, is it over? 4-year cycle, something else. This is one of those real first opportunities that we've seen a deviation between the two. And I'm really curious to see how this plays out. Possibly because we stand to gain a lot of money through investments, but also because I think this is just an interesting concept overall. Because theoretically, we could get a definitive answer. Granted, there's tons of layers, but we could get a definitive answer. That would be pretty sweet. I know.
And
Data
keep in
nerd.
mind, keep in mind, he stated that before he said what came up with all the different ideas they thought why this is a 4-year cycle, why we broke, and they have a whole team of quants that just work on this stuff. So they've got analytics, they have so much information at their disposal, and that's their job to identify patterns and what's going on, and they can cross-reference this with so many different things. So once again, I mean, they're putting their money where their mouth is. Like they're just telling you what they're seeing and why they're doing it. So once again, are they wrong? If they're wrong, I mean, they still make a pretty compelling argument, and you can still be right and get it wrong. It's still possible. Your timing could be off. You might think that, hey, this is going to be so far a long-term investment. I think it's a no-brainer. Short-term, it's always tough. You don't know what may happen, and that's kind of where we're on. Where everyone's torn between right now. Now, the last one is very compelling for the long term. He's going to dive into why people are basically. People say, oh, you're going to tokenize assets and put them on let's say the Ethereum network or blockchain in general. I don't think people understand what that means. And he does go into that. And I think not just explain what that means. It's not just digitizing it, but it opens up a whole new world of how we can look at investments. And I think it's really fascinating. So you can dive into that one if you want.
That's true. Real quick, I do want to close out the 4-year cycle discussion, though, because the other half of the clip that we did just watch, he talks about why does the 4-year cycle exist? Well, this is widely discussed and speculated, but this is coming to us from Cointelegraph. Pretty much the traditional 4-year cycle, a lot of the basic idea behind it is around this. The halving rewards people get for solving the Bitcoin blocks. Back in the day, that was a lot of Bitcoin. That was 50 Bitcoin. Granted, it wasn't like monetarily massive because at that time, Bitcoin wasn't even worth like a penny, I don't think. But the way that the halving works is that it's halving the rewards. So you're getting this like exponential or logarithmic decay going on. So currently, we're sitting right at 3.125 Bitcoin. Granted, that's still like $300,000. But at the same time, though, we're going to see this keep chopping up more and more. So it does decrease the value behind solving the blocks, but the decrease is diminishing. But we're kind of coming off the tail end of the massive declines because we went from 50, 25, 12 and a half, 6 and a quarter, 3 and an eighth. So now we're going to about 1.5 effectively. But what this really did is what people kind of have surmised about the markets is that the previous 4-year cycle theory was based off of this as your supply curve, and then also the demand curve partly driven by price. So what would happen is that you have the halving. It makes Bitcoin more scarce. There's less of it coming out into the world, and people are holding it theoretically. Therefore, you are having a continuously growing amount of people entering the market looking for it. And then also at the same time, you have your supply starting to halve. What that does increases price. At that point, it kind of goes into phase 2, which is the famous market psychology chart, where it's really a lot of market psychology going on about how the price is being driven. It'll go up and up and up. And then ultimately, it will reach a point where it kind of breaks the psyche. And then people are like, all right, that's it. That's the top. Whether it's a macro event, whether someone makes the top, then you kind of see the downside, which is a compounding effect, or that catching the falling knife, as some people like to say, with the charts with tons of red candles that look like they're never going to stop. And then ultimately, you get to the other side. This is still before happening, by the way. You get to the other side, and there's kind of that bottom, whether it's news event, someone makes the bottom, or just overall consensus. And then you start to climb back up. Halving happens, supply drops again, repeat the cycle. That's the previous theory for what's going on. Tom Lee is positing all the stuff that's different. It's very possible that both these things can be true, but one used to be true, one is the new reality. So again, that's why this is the big question in crypto right now, because it could be a historic transitionary time.
And just to add, I think the halving, like you said, the halving is having less impact now, because most of the supply is out, and your return on investment is diminishing because of how much little you're getting for mining it. And not just that, but the cost of the power, electricity to run that is become more expensive. And I think last week we showed what it was. What was it? 74,000 Bitcoin. Is about 74,000 was the bottom.
The cost of mining a Bitcoin
it
was about like 70K.
which is nuts. If you go back and look at what it was just even a few years ago, it was it was a lot less than that. It was,
Yeah, it
what
was
was
like,
it at 15, 17,000, something like that?
I want to say it was even lower than that, probably around 10K.
Okay. But anyhow,
You
we had
guys,
the chart up last week. It was just really fascinating to see how quickly it's gotten expensive.
yeah, I mean, part of that is that average cost that we showed. Again, the grain of salt to take with that one is that is an average cost of making a Bitcoin. That is electricity, that is hardware, and that is not taking into account the ongoing battles for both of those resources, by the way. Electricity only getting more expensive, more demand for electricity. Thanks, AI. And then also the mining, the hardware. It's constantly improving. And we went from just computer mining, graphics card mining. Now we have full on ASICs, which are dedicated machines that have one single purpose: to mine Bitcoin. No other function, not even a desktop. They are there to do the not the encoding, the encryption. Excuse me. Thank you. Yeah. So like it was a good chart. It was a really good one, by the way. But at the same time, again, please keep in mind it's an average, but it is interesting to look at because when the cost of Bitcoin goes down, touches it, even dips below it, historically, it's been a pretty good price to get in. Alrighty, back to the man of the hour, 1730. All right, tokenization. What do you have for us, sir?
Undervalued. Okay. And in the final minutes, I want to talk about why tokenization is a bigger unlock than you realize. Larry Fink says we're at the beginning of tokenization of all assets. And there's 5 reasons tokenization unlocks things, okay? It's fractional ownership. It does reduce cost. It allows 24/7 global trading. There's more transparency. And in theory, there's more liquidity, okay? But I would say that these are just the raw ingredients. And in our minds, tokenization is actually going to take Wall Street into a next level of evolution. And what I mean by that is we have to understand what you can do differently if you begin to tokenize assets, especially combining it with prediction markets. For instance, most people who are talking about tokenization are doing what I call a very simplified view. They're going to take a painting like this and they'll fractionalize it. So you can own one grid of this asset. But a second way to do a tokenization is to factorize a business, okay? So let's say we break this painting down into its prime colors, and then you can just buy, whatever factor you want. An example is Tesla. For instance, you can time tokenize Tesla. You can buy the NPV of earnings on a specific date. You can product tokenize. You can just buy the present value of a specific product stream. Okay, so in other words, it's blending prediction markets with actual ownership. You can geographically tokenize Tesla. You can buy the NPV of a specific region, or you can financial statement tokenize. You can buy the tokenization of its subscription revenues. These will all still solve for the price of the stock, but you're going to create an unlock that better explains the price of Tesla. For instance, we know Tesla's stock price is the sum of its future earnings. So let's say that you could tokenize and purchase a specific year of Tesla's stock earnings. And we know that Elon Musk is going to get his pay package based on a 10-year plan. So you may only want to buy the present value of 2036 earnings. So you can do that today with a prediction market, or you could actually have this as a true tokenization of the stock, and everything else is the other time periods. The second example is product tokenization. We know Tesla is EVs, robotaxis, full self-driving. I don't even have Optimus Prime, solar, but of course, ultimately, the biggest value of Tesla is Elon himself. So if you could tokenize Tesla stock, you could isolate the implied value of just buying in Elon Musk himself. And as you know, he's an N equals 1 person. Okay, so that's tokenization. I think, of course, you need smart contracts and prediction markets, and really working in conjunction with both is what is, in our view, a huge unlock. And in fact, BitMine is trying to find projects that are really moving this forward.
All right.
Right. So this is where you can see things can get very granular. It's going to open up a whole new world of products that now TradFi can now offer customers that can really open up another wealth of products in the industry. It's interesting when he was talking about the prediction markets, because the Polymatic network that they have all these it's going like gangbusters. Like people are betting on anything and everything you can imagine they're betting on. So it's getting it's getting explosive. Then you look at like what's going on in betting in the sports world. Everything is so granular. You can bet on anything too. So anything you've got money you can put toward, you've opened up this whole world of market. But by tokenizing this thing, now you have the it's that digital receipt or digital certification that you have asked that this is there. It makes it much more simpler and more streamlined and less overhead, less everything across the board. It really simplifies it and allow them to move these products much faster to market. When he talked about the product tokenization, think of this as kind of like when ETFs came out. So when ETFs, exchange traded funds, they're on trade, they're all over now, everywhere sees them. But back then, if I wanted to own, say, I want to own the technology sector, I want to own like a certain tech sector, we'll say just small cap, the top 10 small caps, blah, blah, blah. I'd have to go out there and build my portfolio around that. Or you just buy the dang ETF and it mimics the exact same return that you were trying to accomplish without having to do all this overhead. So this is going to take it much further. This is going to, like you said, you can decide, okay, what part of Tesla do you want to invest in? How far out do you want to invest in? Those are just basic, examples that he's laying out for you. But you can start to see where this is really going to blow up in the tokenization aspect. And like you said, Larry Fink is already saying now, Larry Fink, BlackRock, now you throw BlackRock in. Now, didn't we just see State Street just get involved with investing? Vanguard. Sorry, that was the other three. So
the notorious sayers from 2 years ago.
The three big boys.
We're
actually Vanguard. Right. So you got Vanguard, you got BlackRock. They're already all in. I mean, Vanguard just got to the party. State Street will get involved. It's just a matter of time. And so all these big players are getting in here, and they're moving. And you keep hearing how they all aggressively want to move everything to the tokenizing it all. And it's because of how many products it's going to open up and how much overhead gets eliminated, because they don't have to worry about all this stuff. Like even in TradFi, there's still tons of paperwork. Unfortunately, they want to get rid of all that. If you can tokenize, now you've got that. Like we always say, it's a digital receipt is the simplest way to make people understand, to where you just cut out everything. If I own this and it's mine, this is my receipt. Now, there's only one receipt that I got to show that I have this. So it's interesting. So like I said, I'd recommend anybody go out there and watch the whole presentation. It's only 30 minutes long, but he dives into a lot of other good, interesting things too. So it's a great insight. And that came out, I think it was about a week ago. It was like Tuesday. I think it was Tuesday, or it wasn't that long ago. So this is fairly new. It was within about a week ago when that came out.
Excellent. I mean, the cool thing about that description of tokenization, I think it does a good job of breaking down the idea of what is it, but also unlocking the possibilities. Like all the different versions that he talked about there, that's stuff that I don't really think I've seen talked about a whole lot out in the crypto sphere and whatnot. So those are very cool ideas, but at the same time, though, I understand how people can look at, especially that part of the presentation, and think to themselves, this is very complex. We don't even know if there's going to be a market for this degree of tokenization, or like, if this is so big, why isn't it here yet? Well, the answer is partially because it takes time to get there. And then also you have to have the desire for it. But it's something that we've talked about as well. And I'll mention it again, which is that if you think that this stuff is far off, I would urge you to please reconsider. This actually came out this last week as well. This is Paul Atkins, aka the head of the SEC currently. If you remember, we covered probably back in March, April, I want to say, they had a press release where they said they wanted to see all U.S. markets on chain. Didn't have a great time scale for that one. This time he did. In the interview, he said it's possible to see it under 10 years, 5 years, and his shortest term answer was you could even see stuff coming out within 2 years for having U.S. markets on chain. And again, to talk about other stuff we've also talked about before, we've already seen people experimenting with putting home loans or home titles, on the blockchain as well. So is it easy to kind of say like this stuff is further out than we think? Yeah, for sure. But at the same time, like prototypes, experiments, they're happening now. And we already see the buy-in from TradFi. They've invested so much money into crypto. At this point, it wouldn't make sense for them not to go further with their initial investment already.
It was funny when I first saw that video. I immediately thought that was Ross Perot before I looked at it. He looks a lot like Ross Perot, man.
A little bit for
Anyhow, yeah, I can see. Here's the thing. It's already started. They've already started tokenizing stuff onto the chain, and I think there's $150 billion worth of assets already on there on the chain, something like that. And that's another thing that Tommy was talking about, was people aren't looking at the network effect, which is what's the value of the assets on chain. And I think they've come up with this. You gotta understand, all this stuff is so new to how do you price any of this stuff. And that's why people are really struggling with it. It's no different than when e-commerce came out and social media came out. We know there's value there, but how do you put a value on that? Like for social media, how do you put a value on social media? But that truly is a network effect, right? You have all these users coming onto this ecosystem, and it's generating, advertising and various other ways of profiting or monetizing the network effect. So how do you do this with on chain? Well, if you do start with at least the underlying assets that are on chain, you might want to start there. That's where it gets you to that. What is it? 300 billion is what Ethereum's currently at, something like that, because there's around 1.5 billion dollars in assets on chain, something like that. Yeah, it's about 76 billion is what we're currently at for Ethereum. If you take roughly half of that, that's about the value of the assets that are actually on the chain itself, and that's what they're coming up with that number. So if they're talking about tokenizing things, keep in mind, if they move through some of the predictions that we're seeing by 2030, there could easily be $2 trillion worth of assets on the Ethereum network. If you do take that simple napkin math, now you're at $4 trillion just in Ethereum. Well, $4 trillion for Ethereum is quite a bit of a bump from 376 billion. Sorry. So yes, all of this is just now. Bottom line is there is enough coming to feed the narrative that these are going to have to get priced in TradFi value, and I think that's why you're seeing this such a struggle. And like I said, this was the same thing with .com. Like when they came out with Google and Facebook and all these other technology disruptors, Amazon, they didn't know how to price these things. They had no model previously to be able to apply this. So they're having to create new models to figure out how to value these things. And you're seeing people at the tip of the spear, like Tom Lee, trying to figure this out. So it's interesting times. It's definitely interesting. This feels like, I mean, it really does feel like .com all over again coming with, and I know you're talking like but then you have multiple technologies that are coming out. You have, cryptography and blockchain's been around for a while, but not till now it's being actually introduced to real world solutions that you're starting to see come into play. Yes, there's been some DeFi, there's been other advancements, but now you're starting to see this actually apply to what more TradFi in revolutionizing the financial markets, and it's being a huge disruptor. I know I saw something come out from this week. It came out of the IMF. The IMF is coming out stating that crypto and this is a huge threat to the infrastructure of the current financial institutions, and that's a big threat. And they were urging governments to step in and try to stem this a little bit. So you have one side of it trying to hold on to the old ways, we'll say, while there's advancements of others parties are saying, no, we're moving forward in this direction. So there's definitely a tug of war across the financial industry around the world. But we have to evolve. Things have to change, have to evolve. So that's happening. So and then you throw AI into the mix. Then you throw in quantum computing in the mix. Then you throw, with Moore's law that we keep talking about, which is just the advancements of how much computing power do you have versus what your software can run. It's always a balancing act, but we're definitely going parabolic. I know I'm rambling on, but you can just see everything just laying. You can just see all the pieces being laid out right now. We're going full force, and it's happening. For those who ever watch Joe Rogan, I watched him interview the CEO of the chip manufacturer Oh God, I'm drawing a complete blank.
Oh,
NVIDIA. Sorry, NVIDIA.
Oh.
The CEO of NVIDIA. He was interviewing him, and that's a fascinating story. If anybody would want to listen to that, it's fascinating because I think the backstory of his life was really fascinating, but telling you where he thinks things are going and how quickly they're going to go and how advancements are happening. So it's really interesting. But I still think that AI is definitely in a bubble. And I think that is going to be what's going to be the ripple effect that's going to end the bull market. We're not there yet. I don't think you see like all the smart monies, and we've said on the show, you do not see bubbles pop. At least we've never seen really bubbles pop until you see money getting expensive or more tightening is occurring. Well, that happens when rates are going up, when quantitative tightening is happening. We're the inverse right now. So I don't see that happening. The only thing that I see it's a huge headwind is how bad is the economy on Main Street. And that's the big bugaboo that everyone's kind of watching. But that's another reason why, honestly, why I think they're going to be so aggressive on rate cutting. I think when the new administration comes in, we're going to get another rate quarter, potentially again, maybe in January. That one's still kind of like you saw the numbers. It's leaning towards maybe no yet now, but come May, when Jerome Powell is out of there, you're going to have a new administration in place, and that might be a lot more aggressive. I mean, they might come out and do a half a cut right away. Who knows? Because I feel like whoever's going to be nominated, I don't know if they came out if it was that was it Cat Assets? What's his name?
Oh, we talked about it last week.
Yeah, because we actually said the name Asset is in the name, which I thought was hilarious. And others have picked up on that. That's really funny.
Scott Bassett.
There you go. So he's going to come out. So regardless if it's him or somebody else, whoever the administration is going to pick, they're going to do they're going to basically do what they were put in power to do, and that's cut rates and be aggressive with it. And that they're going to do that, rightfully so. And that's what you're going to see. Whether you like it or not, it's going to happen. So
that's true. Or excuse me, Kevin Hassett. That's what it is.
Is it Hassett? Okay, thanks for clarifying for us. I just remember I thought it was funny he has the word name Hassett, and I thought that was just a trip. But what I'm trying to ramble in on here about everything is that we just keep connecting the pieces every week for everybody here on the show. And it's funny. Now we're coming full circle. Now you've got somebody who is a huge TradFi, innovative investor, and they got his team looking at it. And they're looking at some of the same things we've been looking at for a while. So, and they're not even looking at everything we've been talking about. So there's more stuff. Now they're not going to share everything because obviously they have customers that are paying for stuff. They're high clients, but I just find it fascinating that we're seeing it. They're seeing it. We're definitely moving in the right direction. So I still expect things to change and pick up. And like we talked about, I mean, the markets seem to be wanting to bottom out here. And is it the bottom? I don't know. I think we're kind of caught in a technical and just the TA. I think the Ethereum is in a downtrend, bumping up against the down channel, but it looks like it's trying to break out of that downtrend. It's in this downtrend channel. It's trying to break through that. I think it will. I think it's going to break through that. And I think we're going to, start just keep climbing up a little bit. I think if we take this little stair-stepping retracement to get back up, it's more sustainable than just a quick snapback reality. So you can literally see the channel. Yeah, you can literally see the channel. We're bumping up against the top of the channel right now than the bottom.
Yeah, I think that Bitcoin and Ethereum, from the chart standpoint, are at similar spots that are able to give hope. Again, higher lows on RSI. But additionally, if you look at your moving averages, our turquoise line here, that's our 20-day moving average. We've gotten above it and stayed above it for about a week now on Ethereum. Bitcoin, similar story as well. Got back above that 20-day moving average, came down, retested it kind of once, twice, and now we're sitting back above it. I'm not saying it's definitive, but again, it's the inkling of hope. It is the light at the end of the tunnel of possibility. I'm not saying it's guaranteed by any stretch of the imagination, but the idea that what Tom Lee was talking about the clips, that there's a decent chance that this could be the local bottom, that we already hit it back on November 21st. Since then, we're starting to build again. Granted, I was definitely proved wrong when I said the same thing right here before we went all the way down. But these are the kind of structures that you need before you start moving up to higher levels. You got to start making those higher lows before you can keep going up. You got to make the higher lows before you can keep going up. That kind of stuff.
Where's the 50-week moving average? Since that's the one everyone's kind of been targeting on. A lot of folks are looking at that one. So
still sitting under it.
Right. You could still make a case that if we rally, we could definitely rally back to that 50-week moving average.
Oh yeah,
And
it's
then
currently at
and then
102,000.
yeah, I think we'll rally back to the 50-week moving average. Then you're going to see what happens. I could see a little rejection there. And then it's going to be interesting to see where's the rejection pull back down to. But I think we will get up to that 50-week moving average. And then we're going to go back down like we always do, retest, and see where it can find a floor. If it's building this, a stepping pattern going up, maybe it'll build that floor and have a lot of good solid support there, where the bulls are going to come in and step in and start buying it up. Yeah, if you were a sell now, obviously if you had hindsight, selling, if you were selling based on that 4-year, you did real well. But I think once again, I think kudos to you for holding your line by just holding your guns. But if you sold at any time towards those tops and re-entering in at these lower positions here was a really smart move. Even if it was half of whatever you took off, would to me as a good risk reward, even if it's a short-term play to get back to the 50-week moving averages. But yeah, to each their own. I think, markets, what do they say? Flat, nobody can really make money on a flat market, but as long as there's ups and downs, bears and bulls can both make money.
That's true. Yeah. It's definitely a little more risky, and you got to know what you're doing to make money during those kind of times, either it's fluctuation or flatlining. At that point, you're looking at either swing trading or you're looking at getting in on the other side of the options game, which is you are actually offering options contracts instead of buying, and you're collecting the fees from the contracts. So the analogy of picking up pennies in front of freight trains feels very apt for that one, but at the same time, it's possible. There are people that do it, just like there are people that chase the dividends in stocks or do the daily swing trading on the 15-minute chart. Like, there are ways to do it. It's just different levels of risk. Understand what your game is, what you're going for, and whether or not you have the edge on it. Because that's really one of the big things, is that this is player versus player, baby. This is the open free market. There are people out there that stare at this screen 18 hours a day and are in it, locked in it the entire time. You got to understand that's who you're going up against. Unless you're willing to do that, you got to find some other edge. I happen to think that our edge here is we have a good bit of an informational advantage, and we pay attention to these things. We're trying to build a deeper, more broad understanding of everything going on, and that's the name of the game that I think we're all playing over here.
Correct. Me personally, I've got my long positions all still on. If anything, I had more capital. I was injecting at these pullbacks. I was just loading up more into those positions. I'm looking to hold. I don't look to do anything. If anything, if we got back to the 50-week moving average, I'd probably just take something off. Not a lot of the portfolio, just take something off just in case we do have a little retracement or we pull back just to kind of, DCA at lower levels. Nothing wrong with that, but a little bit of risk management. But outside of that, I just feel like so many things are piling up. I like it because there's all these narratives that are very bullish going in 2026. And there's so many people, certainly in the crypto market, that are so bearish right now that, crypto's done, everything's over. And I don't know. I don't want to be, I would rather be on the contrarian side. I'd rather be in the smaller camp. I don't want to be in with everybody else who's basically saying like, oh, this is all over and done. Not just to be the contrarian, but all the evidence that we constantly pile on the show as well.
Oh, for sure. Yeah. No. And which, by the way, folks, if you liked all the stuff they were saying on the show, there is a place where you can get even more of that. If you guys head on over to walktheblockndf.com, you can find sign up for our private Telegram where we post a lot of data, which, by the way, I do realize I have to post some data in there after this because I mentioned I was going to cover the size of quantitative tightening and easing in the beginning, and I accidentally skipped over it. So I will be posting the data in there for all of our fantastic members, which some of you guys did show up tonight. It's a pleasure to see you. We got Will, who's giving me flack for being a little late. Sorry, we got caught in the green room. And then also Centurion 54X, good friend, good guy, also in the Telegram. Just good community we got going on over there. But yes, that is where you can find access to us. We like to say that the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. When we all work together, we can all win together, baby. Excellent. Alrighty, apologies, folks. I know we didn't quite get to the privacy token stuff, but your TLDR is that, well, the ZK token on Ethereum is getting sunset. There's a new project on Pulse Chain called Railgun, or I believe it's a fork of the Railgun protocol. But the other big one is right here. The SEC is hosting their own roundtable for financial surveillance and privacy. This is happening the 15th, which is next Monday. But one little thing I do want to point out from here, the founder of Zcash is going to be there. So Zcash has been on a pretty legendary run lately. They actually had about a 2,000% growth over the course of a few months. Granted, during the retracement of Bitcoin, that is down 60%, but at the same time, that's still up 10x from where it was previously. So I will be watching this one myself just to see what that guy has to say. And yeah, this is again being held by the Crypto Task Force. So good to see that the SEC and the executive cabinet officials are sticking to their promise of actually being involved in crypto and talking with people in the community. So I'm looking forward to that one. Tracker, any final thoughts or things you're looking forward to before we get out of here?
Oh, the rate cut coming would be nice, just to get that out of the way and see how the markets digest. Just watching to see how the markets respond on building them up. I know folks over in Pulse Chain saw a big pump in the area last night, just to be followed by some sell-offs. A lot of things are happening over in Pulse Chain. I think it's been a very frustrating hold for everybody. I just think that personally, I'm not looking to make any movements yet. I think those positions are just there to stay and waiting to see what transpires and comes out of this. But ultimately, regardless of what altcoins you guys are holding, you're hostage to the ISM number. We're all hostage to that. Once the ISM number starts going up, you're going to start seeing things move. And when is that? Nobody has a clue. We're trying to do the best forecasting we can for everybody here, but ISM number is literally the key that will unlock the altcoin season, is what it certainly feels like. So we just have to sit there and be patient. So hold there, be tight. Have your positions on these big pullback. If you get a rally up, maybe take a little bit off, just so you have some dry capital. So if you do go back and retest and have these pullbacks, you have something to put towards. It's much more easier to stomach when you can build in these positions on these pullbacks. That's one thing I would say. I'm not trying to tell you to be necessarily a trader. I'm just saying be smart with your overall portfolio.
Correct, because we would never give financial advice here on YouTube, because that would be unprofessional and against the law, apparently. So
yes,
there you go. You got to make decisions for yourself, but we're definitely all hunting for information together. That is what we do best. We would love to have you if you choose to join us. Excellent. Alrighty. Well, that pretty much does it for this evening. Like you said, we're looking forward to Wednesday. The Fed meeting is coming out. We are anticipating a quarter point cut. There's a chance we might not get it. Jerome Powell might just be pissed off enough from last time to try to stick it to everybody that's speculating, but it might be a little out of his usual way of doing things as well. Outside of that, a lot of interesting stuff going on. We will always be keeping up to date with it, you guys, and bringing it to you guys on the Monday live streams, which will be free forever, 8 p.m. Eastern time, or a little bit later when we're trying to adjust for the day job stuff. Shout out to Dace. He's doing great work at the day job as well. So hopefully he will be with us next week. But outside of that, we do want to thank you guys very much for tuning in. It has been an absolute pleasure. Good fun show. Hearing the Tom Lee clips was excellent, and we hope you guys enjoyed it as well. So until we catch you guys next time, I hope you all have a fantastic evening. Good night.